the week ahead. For the past 3 weeks, we have talked about the balance trading guidelines. Finally, the market has broken to the downside. So we have the downside breakout. When you look at the graphic, you had 2 downside breakout failures. When they fail, the object then, the market will generally rotate to the opposite extreme, which it did. This one didn't. And of course, think of it this way. 1 time down, 2nd time down, more price acceptance. The 3rd time down, you're getting more price acceptance of this lower range. So you've got a downside breakout. When you get a downside breakout, the rule is go with it. Now, to have a better understanding, at least what I think has taken place, if you look at the graphic from the lows down here, 12 of those days, 1 time framed higher. What that means is the low of the 2nd day did not take out the low of the previous day. And that usually you don't fight that, you just go with it. But to understand when I make a comment that generally I think that the long inventory as the market balanced up there was by very weak hands traders, weak hands momentum traders. Now people always ask me, well, yeah, but how do you arrive at that? Well, you never know for sure. But one of the characteristics of weak short-term momentum traders is they love to buy lows. And that leading to, 12 days of 1 time framing higher would be consistent, with traders buying lows. Now, that's okay. And that's what they're going to do as a short-term trader. You go with that and don't fight it. But you want to be aware of the inventory building. Is it in long hands and strong hands, or is it in weaker hands? And the odds are it was in weaker hands. Now, with that long explanation, I don't know if this is going to happen, but it does increase the odds that before this current break is over, it could take back all of what you see on the graphic. The next lower reference would be the gap. We got a gap coming up that we'll be looking at early next week, whether it takes it out or not. Takes out that gap, of course, then the market has the potential to go back down. Now, I don't know if it takes out all back, but that certainly should be one of the considerations. Short-term traders, where traders get hurt a lot, when they see a market going down as this has gone down, they have a tendency to want to buy breaks and this idea that, it's going to go back up. A much better, sounder strategy is to be prepared to sell rallies. When you get the breaks, they're probably short covering breaks, and then the better trade is usually to sell into those rallies. Since the trend is now to the downside, your strategy should be more to sell rally, not to buy breaks. You may take profit on breaks, but historically, traders lose a lot of money by continually buying breaks. So remember, I think the better strategy is to sell rallies. Now, the next thing you want to look for is right now, the market has shown no signs of coming into short-term balance. So you don't want to get too anxious. It may go all the way down. It may come into short-term balance. But if a break of this magnitude, before there's any real recovery, the market should come into short-term balance. So right now, as we start next week, the trend is down. The next reference is the gap that you see on the left-hand side of the graphic. Have a great week.